behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in, scorching hot, I presume, Scottsdale, Arizona.
90 degrees is not scorching hot. I know for Buffalo, the entire place would melt, but for us, no problema.
You know what, Toby? Here's an interesting fact. Buffalo, New York has never hit 100 degrees. How about that?
So I literally am shocked. I would have assumed that maybe in a nuclear blast, it would get to 100 degrees.
Yeah, right. I know. Yeah. 9 months of snow. That's for sure.
Right.
But with us today, I'll tell you one guy who is hot because he's got some great advice for all of his clients. That's Tom Bruce. Tom is the macro investment strategist over at Tanglewood Total Wealth Management, located in Houston, Texas. Tom, welcome to Buy, Hold, Sell.
Thank you, Todd. Appreciate the opportunity to be here.
Absolutely. Well, we're happy that you are with us today. So, Tom, I got to talk about, obviously, yesterday's price action in the markets was just amazing. We saw the S&P up over 3.26%, truly remarkable. And now today we see the S&P, as we speak, the S&P 500 is now pushed into positive territory for 2025. Can you believe this index was actually down 17% at one point this year, Toby? Truly remarkable. And here we are positive. But Tom, I do want to start with you, though. What do you think about that market action right now? I mean, would you be overweight equities at this point?
Well, what a ride it's been since the highs back in February. We've gone through a lot. There's a lot of events have transpired since then. And, from Liberation Day to now, we're going from almost a 100% chance of being priced into a recession to now most strategists are talking about a 30 to 40% chance of recession. So we've come a long way since then as trade tensions have died down a bit. The market's come a long ways too, though. It's recovered, I believe, a little more than everything it's lost since April 2nd. And now, as you said, it's positive for the year. And the all-time highs aren't that far out anymore. So for me, that gives me some pause because we have a lot of unresolved issues going on. I wouldn't say that I'm bearish. I wouldn't say that I'm bullish so much right now. It's more neutral. I think a lot of what we've seen over the past month has made a lot of sense within the greater context of what's going on. But the market's come a long way. So it's priced for, I wouldn't say priced for perfection, but it's priced, a lot of the good news is already priced in at this point.
Okay.
Yeah, so you're basically saying we entered economic anarchy, and somebody threw a giant, Mazel Tov cocktail. I don't like to say Molotov. It's just how I roll. And, everybody had to throw their playbook out. What did you do when everybody had to throw their playbook out? Go to cash? Go into Germany? DAX, my third largest position? I never thought I'd be like, Achtung, I'm up 42% in Germany, a stock market that hasn't moved 42% in 10 years. I mean, how about you, Tom?
Europe has had an amazing time, particularly Germany and Poland. What you see in Germany is the combination of interest rates falling from the ECB, along with fiscal stimulus from funding defense and infrastructure. That's a very powerful combination. Yeah. Couple that with a declining dollar, and you result in the rally we've seen. It's pretty amazing. Now,
well, what do you think? Should I be taking profits here? What's your call?
Well, in my opinion, this could go on for a while. What you see is a combination of fiscal stimulus and monetary policy. That can have some duration to it, but I still feel like Europe. It's not leading in innovation. Mario Draghi came out with a very important report last year, speaking about the European competitiveness.
Right.
And they haven't really addressed that. They may be making some baby steps going that direction, but there's a lot of work to be done. So are they going to compete with Silicon Valley in a sense and drive AI and a lot of the emerging trends you see that are going to be with us, into the 2030s and beyond? You're probably not going to see that out of Europe.
Yeah, I mean, you make a great point. Silicon Valley is like the reverse polarity of Germany. And for all these sort of obvious reasons, I'm sure all our viewers understand. But the structure of Germany, as you're saying, just does not let, you have SAP. Well, they're not in Germany. In Europe, you have other tech companies, but they're in France or they're in the UK. Germany is whole, but they know how to make weapons like crazy. And I'm still long essentially the weapon makers there. Although we trimmed, one of them I think was up 200% for crying out loud. But they were selling at 4 PEs for crying out loud. I mean, if you compare them to the United States, I'm just trying to do like the parity valuation trade. That's what I'm looking at, and I think we're pretty much there to your point.
Yeah, and that's another factor going in Europe's favor too, right? This valuation. The U.S. is more or less a growth market, and growth had been out of favor coming into 2025, especially after DeepSeek came out. But even preceding that to some degree, a lot of those valuations were in question, and that was a major headwind for a lot of the big tech names. So naturally, there was already a move towards value going into this year.
Yeah, right. And then we had this Liberation Day, and people said, "Well, I don't feel that liberated. I feel a lot poorer, but I don't feel liberated. So I'm going to use those tech names as source of funds for the tariff-free, risk-free thing." And all of a sudden, Hershey's is doing well, and McCormick's Spices is doing. It's like that was like the classic. Get me the F out of here. I have to have positions, so I'm going to take the essentially non-discretionary stocks and just ride it out. And frankly, that's what we did, except that we also, really like the aircraft makers and the bomb makers and the aircraft surveillance and the other stuff that they make in Germany. So that was our safety trade, if you will. But have we hit the bottom here, young man? That's my question. In the United States market, that is.
There's a lot of signs that's the case. Certainly, the breadth that we had coming out of the very brief bear market. I don't know if you want to call it that or not, because we didn't close 20% down. But a lot of technical signs show that yes, that was a bottom. But I think the ultimate answer depends on whether or not we go into recession. Because if we go into recession, we're probably going to see a more extended bear market in that case.
All right, what's your recession case? Because I don't believe it.
It's getting weaker by the day, especially this week. The case would be, well, there's a lot of unknowns that could drive it, but weakness in essentially weakness from the consumer related to potential labor market softness if we continue to have trade problems going forward. It looks like deals are out to be made right now, so that's most likely not going to transpire. As far as there's other issues in the economy, like housing, so for example, but I don't think it poses a systemic risk this time to actually generate a recession. It's hard to say.
Well, what's the issue with real estate? Do you see problems with housing?
Well, the main issue is mortgage rates where they're at.
You got rent.
The combination, the combination of relative, high prices and mortgages have just made housing costs very unaffordable for most people, and it's frozen up the housing market in a lot of places. If you look at the Sun Belt, that's the area that's been affected the most by this. And one of the areas that's been growing and has had a lot of new homes built lately. You've had prices declining in parts of Florida and Texas. I believe, I may be mistaken, I believe Arizona may be declining as well. So it's not a nationwide trend right now. You have a lot of the Rust Belt and parts of the Northeast that are doing well. But you do have that kind of reverse migration going on from places like Florida that were affordable and became more expensive. And someone from Florida, when you look at what you get in say St. Petersburg versus what you can get in say Ohio, it becomes more compelling to look at other options if you want to own a home and you can't afford to buy one in St. Pete.
Yeah, if you use the $450,000 rule, which is sort of the median price, there's no question. I mean, there's a lot of trades, but there also has to be jobs, and right, that's a big issue in Ohio. Hey, my quick question though is, one of the big fears we had here was the bond market, and essentially instead of the bond vigilantes, we got the stock vigilantes going in against the tech world. But how do you see we still have to issue $2.3 trillion of new debt. We're going to have, I believe, 1.8 trillion rolling over from the 10-year bond at 2% rolling into this new 10-year. That's the one that scares me the most.
Concerns me too. That's been one of the unresolved issues from Liberation days. You initially had that flight to safety in the bonds, then it went right out the other way. And equities have come back to where they were, but the longer end of the curve for bonds has not. The 10-year and the 30-year are higher at this point. And there's a number of theories behind why that is. But like you said, debt issuance is going to be a big issue going forward, especially if it's more evenly distributed throughout the curve instead of on the front end like it was under the Yellen Treasury.
Yeah, I was sort of blown away. Japan owns 20% of our freaking debt. China owns 10-ish, 9.5%. Would you really want to piss those people off with tariffs and tell them to go screw themselves? And then you go to the UK and the EU, they own another 13% of the debt. Freaking Warren Buffett owns what? 5% was in the paper this week of U.S. Treasuries, for crying out loud. I always feel like I was an old bond market guy. That's like the hidden risk here. The other guys can't sell those bonds. They could just flood the market, and then their bonds go down 20% and the value, and then we create this downward negative feedback loop. So it feels like everybody's got nuclear bombs of bonds aimed at each other, and nobody wants to pull the trigger because it doesn't. If we destroy the long end of the market, then that's a recession. I'll go with you on that recession because that one is pretty easy to forecast.
So what's your probability for a recession this year? We had Sam Stovall on yesterday. He didn't give us the impression that CFRA was looking at a recession for this year. But I mean, what's your call? 10%, 20% chance. What do you think?
Given the way events have transpired this week, I would put it around 20, 25, somewhere in that area.
So it's based off of the tariff news, the ceasefire and the trade war. That's really that's the real octane in the decision making on a recession.
Normally it wouldn't be, but in this case, certainly, because you don't want to freeze up the economy in such a way that we might see pandemic era shortages coming up. That would have created all sorts of problems. So with that more or less off the table, it's looking like I feel a lot better about the economy in the second half of the year now.
Yeah, Tom, we have a really close contact, and I was in DC for 30 years, who sent me a very nice note about 2 weeks ago and said that Bessent came in and a couple other people to do an intervention with Mr. Trump based around the next year elections. Mm-hmm. That there's been no Congress GOP that was elected with a 78% disapproval rate of the president, a 59% disapproval of economics, et cetera, and that got him to blink, if you will. Although I've never really seen him blink, so I don't know if he has eyelids. And I think they're bigger, guys got in there and said we're in all the wrong directions, and if we lose the midterms, then we just put us through this horrific nightmare for nothing.
Mm-hmm.
Right.
So that's my base case. He blinked. Well, they said we're quitting tomorrow if you don't pull your head out of your tuchus.
Scott Bessent's proven to be very capable in his role.
He's
great. And Jerome Powell, I think, deserve a lot of credit for the way they've handled this so far.
Yeah, you had in your notes said that you were afraid.
Hold on. I want to tease that because for the audience, and we're going to leave it there on this block, guys, because coming up after the break, we are going to hear from Tom on his opinion about Jerome Powell. You won't believe what he's thinking, because Toby and I our heads were spinning when we read the notes for the pre-interview warm-up, so it was awesome. So listen, guys, with us today is Tom Bruce. He's the macro investment strategist at Tanglewood Total Wealth Management down in Houston, Texas, and he's going to be with us right after the break.
Buy, hold, sell, brought to you by CrossCheck Management.
Welcome back to Buy, Hold, Sell. Well, with us today, our featured guest is Tom Bruce. He is the macro investment strategist at Tanglewood Total Wealth Management in Houston, Texas. And Tom, I got to say, we teased it going into this block. You sent Toby and I a note about Jerome Powell and your thoughts of whether he should remain chairman of the Fed going into next year. Please tell the audience what you're thinking.
It's an unambiguous yes. He's done a phenomenal job throughout the course of his tenure. He's gotten a lot of criticism, but it's always with the benefit of hindsight bias, and that's been one of the more frustrating things about it. In the moment, he's always done a remarkable job, and I feel like he's a source of market confidence at this point. Going into next year, he won't receive the nomination to continue on as Fed chair. So that would be a concern of mine going into 2026 is who's going to replace him and how independent the Fed will be after that. And the way it works, how they all receive votes, if they put someone in who's especially favorable for the administration, they may not be able to do a whole lot, but still, it's not going to be as solid a footing as it was under Powell. So that's one of the things I'm not looking forward to for next year is seeing the Fed under new leadership.
Well, again, going back to Besant, let's not sugarcoat this. If they brought in a mega neo-economic expert to be the chairman of the independent Federal Reserve, you think the 2,000 points down from Liberation Day was big. You would have a bond market convulsion, which would then take all the people who run CTAs and hedge funds at 2 and 3x leverage, which is why we went down 20% in 3 days. If you look at the volumes at the CT level and at these hedge fund levels of sales, they had to sell their margin calls. We would have the world's biggest margin call in the history of margin calls if I hate to say this, but Peter Navarro, that noted economist, gets nominated. Oh my Lord. Yeah. I mean,
but this is for you, Toby. Then I mean, Powell's term ends next year. So
yeah, no, granted.
It sounds like what you're saying is that it's almost inevitable that this is going to be the reaction once he steps down.
Well, again, I'm caught in the Besant factor. If Mr. Besant, God bless his soul, takes the reins of this and tells the president, remember those midterms? We're going to get just blown out of the water if you bring in one of these mega fanatics. And Scott Besant has great relationships with fantastic people in the financial world. And I would have him lead the search because, yes, if the market sniffed that there was going to be, I'm trying to come up with nice words. I just can never come up with nice words for the, a mega absolutionist, a person who, has economic value, who thinks, let's put it this way. In MAGA land, a tariff is not a tax. And every other part of the world, the tariff is a tax. But they live in this distorted, upside down, Alice in Wonderland vision of economics. And I'm sure, Tom, as an actual, PhD in economics, you wanted to barf that day, because I know I did.
Tom, what are your thoughts though? Powell, he's going to be stepping down. You said you're concerned about this with him leaving the Fed. Mm-hmm. What is the worst case scenario then? Is Toby right? Are we looking at a bond market collapse, higher yields? You're looking at a stock market collapse. It sounds like it could be an economic travesty for the second half of Trump's term.
Well, I don't think you can get anyone too extreme confirmed. It remains to be seen. It's possible, but you are certainly going to get someone who is more aligned with the administration. We're getting calls for, President Trump called for rate cuts today, just earlier this afternoon, and I don't know of any mainstream economist who thinks that's a good idea right now.
No.
And if you have a Fed chair who's sympathetic to that, then we're going to have problems going forward. So this isn't really being talked about much right now. This is probably going to come more into focus in the fourth quarter of this year, or maybe late in the third, when we start getting 6 months out, maybe a little bit further. I think it's going to be a concern on a lot of people's minds.
Yeah, well, CrossCheck Media is always ahead of the curve here, so it might not be a headline news story now, but it will be, and that's why you're on the show with us today, Tom. So I wanted to pivot from the monetary policy talk, and let's start talking about fiscal policy. Now you have we have the GOP in charge of all three chambers, so if that's the case, I mean, we should expect tax cuts. I would think at least going into the midterm election would be probably more talk about this next year. But what are your thoughts though? Because we're hearing about tariff money coming in. We're talking about the deficit shrinking, and then you have the talk today where the president is in Saudi Arabia talking about $1 trillion in investment into the United States. I mean, with all this growth and all this great news, I mean, can they table tax cuts going down the line?
Mm.
Well, I do think some tax cuts are coming. Certainly continuation of the existing tax cuts. But I do think characterizing the tariffs as a new tax, as a politically palatable tax, is a good way of looking at it as well. I mean, it's not quite like a national sales tax, but it's something similar to that, and regressive too. So.
Regressive meaning, Doctor?
End.
Regressive, not all our audience are PhDs in economics, so.
Well, it taxes more the people who spend a larger portion of their
paycheck.
Income. Yeah, who spend more of their paycheck. So if you make $5,000 a month and spend all of it, then you'll be getting taxed the most, versus someone who's making $50,000 a month and only spends $10,000 of it.
Exactly.
Relatively speaking, the person who's only making $5,000 a month has a much higher tax rate.
No question. And I always like to point out that I think people miss a couple things about the U.S. economy. Number one, 80% is services, not products. So, there's a pretty big buffer there, and of that, healthcare and other things are essentially, covered by some form of a payment system, unless you're in the bottom 50%. If you're in the bottom 50%, they only own 5% of the wealth, and they spend 110% of their income. And the top 20% are responsible for 80% of discretionary spending. So we have this bifurcated economy that we always sort of say depends on the bottom 50%. That's not true. It's the top 20% that keeps the discretionary spending going, and that at the margin is where we've seen growth, and you've seen stability. When people's 401ks or portfolios went down 25%, not mine, but some other money managers, that's when it snapped shut. You saw Delta Airlines, cancelization. You saw all the sort of discretionary spending, because that's just a natural human response. Like, WTF? What just happened? Okay, maybe I'm not going to sign up for a $25,000 cruise on the Viking ships type thing. But my belief is, and the behavior of human beings is that, okay, I'm back. I'm not down. I still want to go on that Viking cruise, and I think the data shows that the top 20% spending has picked up, and that at the margin will keep the economy, the consumer economy, going, while the manufacturing economy is no question growing. But the question to you is the one I get all the time: who's going to work in those factories? These are not, this is not United Postal Service. Go to the store, take the envelope over, put it in. I mean, they're going to be high tech to be built, high tech to be run. How do you answer that?
Well, you're 100% right, and not every industry is going to come back here. I don't think you're going to have apparel come back, for example, but the ones that do, it's going to be highly automated. And fortunately, we're approaching a point of robotics where they're going to be able to do a lot. They'll be much more capable, say, in the next 5 to 10 years. So the timing, we may be a little bit early for this movement, but in the long run, it's probably good to have it reshored, in a sense that it'll be closer to the final destination, and the actual labor costs that go into it maybe aren't material anymore.
That's a great point.
Yeah, I think you hit on a very good point about the wealth effect too, though, because a large part of the driver of the economy and the markets has been real estate and equity prices going up the past few years. That's something that really hasn't been appreciated as much by most mainstream economists.
Excuse me, pardon the pun, appreciated much?
Tom, final question for you. So with the the clock ticking, it's like a TikTok.
Easy for you to say, Todd.
The clock ticking now in this 90-day delay, the ceasefire, whatever you want to call it. I'm going to guess that they're going to extend this by another 90 days, but let's just say they don't. Once we get closer to the 90 days, are you going to be having these sleepless nights? You're waking up, you're sweating, you're pacing, you're nervous about the economy? Or do you think things are just because everything's looking so hunky-dory right now, we still will have a great second half?
Todd, he's not sweating like you before a date, okay? So just let him answer.
Go ahead, Tom.
I think everything we've seen from this administration, really from the pause of the tariffs on April 9th going forward, it looks like it's a different administration, a much more toned down one, so to speak, that's far more cognizant of what's going on in the markets. So I don't think you want to rock the boat too much going forward, especially given the problems we had in the bond market. I don't think those are fully resolved, and I don't know if we can afford to take too much more risk here on the trade front.
Okay.
I'm with you.
I like that.
I'm with you.
That's a great answer. Well, I do like that. Well, now everybody's probably Googling hunky-dory. They want to know what that means. So we'll save that for another time. So, Tom, thank you for joining us on Buy, Hold, Sell. We cannot wait to have you back. We definitely have to have you back in the second half of this year, especially with that 90-day window. I really want to get your thoughts as we get closer to that deadline. But we do enjoy having you on the show today.
Thank you so much for having me. I really enjoyed this.
Absolutely. Absolutely. Well, coming up tomorrow, we have Dean Smith, not the Dean Smith from North Carolina, Toby.
Oh,
Dean Smith,
you promised me.
He's a fixed income strategist. He's also an ETF portfolio manager. And he's going to be joining us on Buy, Hold, Sell. And then next week on Money Mavericks, we have Bob Elliott. He's going to be on the hot seat for a one-on-one interview with Tobin. You definitely want to catch on and see what he has to say. He's got lots of new thoughts, that's for sure, since the last time he was on. So we want to thank everyone for joining us. And on behalf of Tom Bruce and Tobin Smith, I am Todd Schoenberger. We'll catch you next time on Buy, Hold, Sell. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.